Greetings, Shaun Pruitt here, Zacks equity strategist. Today, I'm going to be discussing why it's time to buy JP Morgan and Citigroup stock for potential rate cuts. So following July's optimistic headline inflation data from the Consumer Price Index, CPI, investor sentiment has continued to peak in anticipation that the Fed could cut interest rates in September. So among the sectors that could potentially benefit the most from lower rates is the financials, specifically banks, with JP Morgan and Citigroup being of interest in particular. And to that point, JP Morgan and Citigroup may be prime beneficiaries of a steepening yield curve where they can finance their operations at lower short-term rates and boost their margins by lending at higher long-term rates. So keeping this scenario in mind, it's a good time to take a look at why now appears to be an ideal time to buy JP Morgan and Citigroup stock. So the first reason is their strong capital positions. So adding to the notion that investing in JP Morgan and Citigroup stock may be lucrative, especially if rate cuts are ahead, is that both banks performed well in the 2025 Dodd-Frank Act stress test, which is an annual evaluation by the Federal Reserve to assess whether large banks have enough capital to withstand economic downturns. So regarding core capital versus risk-weighted assets, JP Morgan and Citigroup both had a standardized CET1 ratio, capital ratio, well above their minimum required percentage of 4.5% at 15% and 13.5% respectively. So JP Morgan had a CET1 capital ratio of 15% and Citigroup had a 13.5% CET1 capital ratio on a standardized level. And as the largest domestic bank in the U.S., JP Morgan stood out in particular with more than $4 trillion in total assets, which you can see right here in this chart, and over $350 billion in shareholders' equity. So JP Morgan is well positioned to continue capital distributions and has authorized a new $50 billion share repurchase plan, and announced it will be increasing its quarterly dividend by 7% to $1.50 per share during the third quarter from $1.40 a share right now. And similarly, Citigroup has illustrated its good financial health by raising its quarterly dividend as well by 7% to 60 cents per share, which you can see right here, going from 56 cents to 60 cents. And it already did that in July. And Citigroup also authorized a $20 billion share repurchase plan and has a strong cushion for any future challenges with a net cash position of over $400 billion. And the second reason, and most important to their stock performance, is the trend of positive EPS revisions. So JP Morgan and Citigroup are more attractive ahead of potential rate cuts as they're already benefiting from a very positive trend of earnings estimate revisions. In the last 30 days, JP Morgan's fiscal year 25 EPS estimates have risen 5%, as you can see here, from $18.53 to $19.50. And fiscal year 26 EPS estimates for JPM are up 3% from $19.75 to $20.38. And as for Citigroup, its fiscal year 25 and fiscal year 26 EPS estimates are up roughly 4% in the last 30 days. And as you can see here, and it's noteworthy that these projections for Citigroup now call for more than 27% annual earnings growth for the foreseeable future. So the bottom line here is, with investors starting to clamor for a September rate cut, the outlook for JP Morgan and Citigroup may become even more appealing. And thanks to their strong capital position, these banks have continued to reward their shareholders with dividends and buybacks, and their stocks look poised to move higher when considering the rising EPS revisions. And as of now, JPM and Citigroup stock both sport a Zacks rank #1 strong buy, and Citigroup stock is up about 60% in the last year, with JPM up about 40%. Again, I'm Shaun Pruitt, Zacks equity strategist. I hope you enjoyed this content. For more, please feel free to visit Zacks.com/promo.